In this presentation, we will work a problem calculating common ratios. We're going to have the information on the left side. We're going to put that information into the blue areas on the right side. We do recommend setting up your worksheets in this format if possible, whenever possible. Putting the information either at the top or at the left of the Excel worksheet, having the text separate from the numbers so that we can refer to the numbers, that being the most efficient way to learn the concepts. Our data is going to include an income statement and a balance sheet, and of course some other prior year information that we will be using in order to calculate some of our ratios. So we're going to go through some of the common type ratios. We're going to do this in Excel, which means we're going to list them out in more of a vertical type of fashion. Note when you see the ratios, oftentimes you're just going to see basically a formula that you're going to put in, plug the numbers in an algebraic type format. That could be easy to see in some ways. It's also nice to break them out in Excel because that's how you basically going to punch this stuff into the calculator. So it's nice to see them inside a vertical type of analysis. We'll make a lot of subtotals so that we can see a calculation by calculation, kind of the order of operations in a vertical type of format within Excel. So we're going to do the current ratio first. The current ratio is the current assets divided by current liabilities. Once again, we're just going to put these right on top of each other within Excel and perform the calculations. Obviously, the current assets are going to be on the balance sheets. We're going to say, all right, current assets are going to be balance sheet accounts. We're looking for the current assets. Now, we've broken out the assets here and don't have the breakout of current and long-term, as you might see oftentimes within a balance sheet, so that we can practice basically picking up what are current assets. So remember, cash is going to be current, short-term investments current, receivables current, and then the inventory is current. And that's typically going to be the differing factor here. Inventory is basically, in essence, where we stop oftentimes when we're considering the quick ratio or acid test ratio. So we're going to pick up the current assets. I'm going to do that with a equals the sum equals the SUM, the sum function. And we'll pick up the sum function, and we're picking up, once again, assets, inventory, receivables, and we want the merchandise inventory, as well as the prepaid expenses. We want all that. We don't want the plant and equipment, property, plant, and equipment not being a current asset. So we'll close that up, and that's going to be our current assets. Then we need the current liabilities. Current liabilities are going to be on the liabilities side. So we're down here in the liabilities. Once again, we've got the accounts payable, the accrued wages payable, the income taxes payable, not the long-term note payable. That's going to be long-term. Oftentimes in balance sheets, you'll see this information broken out. We're going to pick it up with the sum function here so that we can basically practice picking up which items are current, which are not, as we calculate our ratios. So we're going to say that 1905, the 3006, the 2009 is going to be it. And we'll say enter. So then we're going to calculate our current ratio, and the current ratio will then be the 99,500 divided by the 26. So we're going to say this equals the 99.5 divided by the 26,000. That's going to give us our 3.8. So we can basically pay off 3.8 times the liabilities, current liabilities, with current assets. Next, we're going to do the acid test ratio, or the quick ratio. This one's going to be a little bit more stringent. Same kind of idea, a little bit more stringent. Now we're going to be picking up the quick assets over the current liabilities. So quick assets are going to be equal to the sum, and it's going to be looking much the same, except that we're going to go from cash, short-term investments, accounts receivable, and that's it. We're not going to be picking up the merchandise inventory in this case. It's current, but it's not quick in terms of the assets. And then we're going to go to the current liabilities, and that's going to be the same number. So we're going to say this equals the sum of, let's go down to the liabilities, the 1905, the 3006, the 2009, that's it. And there we have it. So we have the same denominator, different numerator between the current and acid test. And then we're going to do the same division. This is going to be equal to the 58.6 divided by the 26,000, and enter. So you can see this is a bit more stringent, of course, because now we're talking about a less or more liquid type of assets and seeing how many times we can pay off the current liabilities with those more liquid assets. Now we'll take a look at days sales uncollected. Days sales uncollected. We'll start this calculation out with the accounts receivable. So we're going to take the accounts receivable. That's going to be how much people owe us. This is going to be equal to the 32,200. Now remember that this is a balance sheet account, accounts receivable. So we're picking up a point in time type of account. And then we're going to divide that by sales or net sales. Now, remember that if you see something like net sales, it doesn't mean net income. We're just meaning net sales after anything. If you see something like discounts or returns and allowances, we're after those because those are kind of reducing the sales items. Here, we're just going to be picking up the sales line because that's summing up the net sales. So we're going to say net sales. So don't let net throw you off. And just remember, if you see discounts or allowances in a kind of a more detailed type of income statement, then you want to pick up the net sales rather than the top sales line. So those are going to be reductions to sales as opposed to, remember, it's not net income, which is obviously down on the bottom of the income statement. So then we're going to say that's going to be the 453,600, and I'm going to have a subtotal. So we're going to give a subtotal here. We're going to divide that out. So this is going to be our subtotal, which will be equal to the 32,200 divided by the 453,600, and that's going to give us our 0.07. So note what we're doing here. We're saying this is how much people owe us at this point in time. And then we're going to divide that by the net sales over the period, in this case, the year. And that's going to give us kind of this ratio, this average of comparing how much people typically owe us compared to the overall sales for a period. And then we're going to multiply that times the number of days in the year, 365. 365, it might be better just to say days in year. And so that's going to give us the 0.07 times 365. And then that's going to be the days sales uncollected. So this is, notice this is a kind of an average type of calculation. It gives us some information. It's not a perfect kind of days sales calculation format, but it gives us a type of a ratio comparing the accounts receivable to the net sales and then breaking that out on a daily basis, multiplying it by the 365. We got the 25.9 for the days sales being uncollected. This is often one of the more difficult kind of ratios to visualize because those balance sheet accounts, comparing them to the income statement accounts, can be a little bit deceiving, a little bit tricky to kind of think about. So mull that one over or think it through. And then we're going to go to the inventory turnover. So we're going to go to the inventory turnover. Another one that's a little bit confusing a lot of times for people to get a handle on, get a grasp of, be able to fully understand and remember what the formula is. So we're going to say inventory turnover. We're going to start it off with the cost of goods sold. Remember that the cost of goods sold is an expense account. It's on the income statement. It's related to the cost of the inventory that we sell at the point of time of the sale. So I'm going to put that in the outer column here. So we're going to say this is an income statement account, timing account. And where is it? It's up top. It's going to be this 297,850. And then we're going to compare that to the average inventory. So this is a term that's often going to be confusing for people, an average inventory. And once again, why is it confusing? Well, it's a balance sheet account that we're talking about here. So a balance sheet account is a point in time. So it's kind of a little bit confusing to think about what an average means. When we say an average for a balance sheet account, we typically are going to say, look, we're just going to take the beginning balance and the ending balance, divide it by 2, and that's going to give us some kind of average or what we think the approximate balance could be at any given time. So it's another really approximation because the balance sheet accounts only represent any point in time. We're trying to get some kind of number that represents the entire time period by taking the average, typically being beginning of the period, ending of the period, divided by 2. So then the question is, all right, well, we're going to start that off then with the beginning of the period, right? And then, of course, well, where is that? Because all I see is the balance sheet account at the end of the period if we're talking about the inventory. So if we're talking about the inventory, I only see this balance sheet account represents the end of the period. Where are we going to get the beginning of the period? Well, that's from the prior year's financial statement. So typically, in real life, we'll have 2 financial statements. We're going to need basically 2 to do some of these financial statements. We'll need the end of last year's and the current year. In book problems, we'll often see the current year and possibly some added information that's going to be necessary for some of these ratios that we'll need for prior year numbers for. So that's going to be down here for us. We're going to say, all right, here was the inventory at the end of last year, and that's of course the beginning inventory at the beginning of this year. So I'm going to do it this way. This is going to be equal to the 48,900, and then we want to add that to the ending inventory. So ending inventory is going to be what's on the current balance sheet. So the ending inventory is going to be the 38,150. And then we'll add those up. I'm going to give that and call that a subtotal. So we're going to say that the subtotal is going to be the sum function equals the sum of those two numbers. So there we have that. And then I'm just going to divide that by 2. Divided by 2. There's the 2. And we're just going to divide that out. This equals the 8750 divided by the 2. And so there we have our average. Now, if you see a formula, typically, if you see this in a formula, they're just going to say that it's going to be the cost of goods sold divided by the average inventory, and they're not going to tell you what average means most of the time, and that's where people usually get hung up, and it's probably better to actually write this out. If you just see a formula, you can't just plug the information into a formula, because what you have to do is a separate calculation for the average inventory, and then plug that into the formula that is given. In other words, part of the formula that you will have will include a whole nother formula that you're going to need to put together. That's why it might be easier, I think it is easier, to actually break this out in Excel in a step-by-step format. These are the actual steps, the calculations that you will make. Now, we're going to break this out a bit longer. It's going to be longer information than a condensed little formula, but it'll actually break out exactly what you're doing when you actually calculate it in terms of a calculator. When you punch this into a calculator, you're going to do this, 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 and it would be easier to see that in kind of a vertical format and think of all the steps. Write out the actual subtotals as we're writing here, as we're thinking through this. And then we're going to say, all right, now we can calculate the inventory turnover. And the inventory, and by the way, this is the average inventory. Now we can calculate the inventory turnover. That's going to be the cost of goods sold divided by the average inventory. Cost of goods sold divided by the average inventory. This gives us an idea of how many times the inventory has, in essence, turned over, how many times we've replaced the inventory. And when you think of a ratio such as the inventory turnover, remember you're basically comparing the income statement account and the related balance sheet account. So we're comparing the cost of goods sold as we sell the inventory. This is the cost of the inventory as we sell it. And then we've got the average inventory, the balance sheet account, which is obviously the cost of the inventory that is on the balance sheet, or the average throughout the time period. Best way we're getting that is basically taking the beginning and ending, dividing it by 2. Next, we'll take the days sales in inventory. Days sales in inventory. We're going to start and compare again the inventory to the cost of goods sold. So anytime you think about inventory and sales, you're thinking about those related accounts, the inventory and the cost of goods sold. So this time we're going to say, all right, here's the merchandise inventory. And that's going to be picking up. Now this time we're going to pick up the ending inventory. So I'm going to pick up the ending inventory, not the average. And we're simply going to be picking up the inventory, the 38,150. And then we're going to compare that to the cost of goods sold. So then we'll pick up the cost of goods sold. And that is going to be equal to, and scroll over to the income statement, cost of goods sold, the 297,850, and then we'll divide those out. That'll give us a subtotal. So we're going to divide this out. That ratio, this equals the inventory at the end of the time period, the 38,150, divided by the cost of goods sold, the 297,850, and then we're going to multiply that times the days in a year, 365. So, and that's going to give us the days sales in inventory, which is equal to the 0.13 times the 365, the 4675. This then being the average number of days or time that's going to be necessary to convert the inventory to sales. Next, we'll take a look at the debt to equity ratio. Debt to equity. Now, this one's pretty straightforward because obviously the name pretty much tells us what we're going to do. And we're going to be taking the debt, which is going to be our liabilities, and we're going to be comparing that to the equity. So we're going to be comparing liabilities and equity. So we're going to pick up the liabilities first. This is going to be equal to, if we scroll back up, we're looking for the liabilities, and I'm going to sum these up because we've got liabilities and equities, no subtotals here, so we can practice summing up the liabilities versus the equity. SUM bracket, so we're doing the sum function here. So here's our sum function, and we're going to be picking up the liabilities of the 19.5, the 3006, the 2009, and the 63.4. Then we're going to stop there. We're not picking up the common stock, and enter. And then we have the equity, which I'm going to do the same thing, equals the sum brackets. And so we'll scroll back up to the equity section. We want the common stock, the retained earnings, and enter. And then we're going to divide those two out, and that's going to be our debt to equity. So debt to equity then is going to be equal to the 89,400 divided by the 163,400, or the 0.55. When you think of this ratio, remember what we're looking at, the equity you can think of as what basically is owed to the owners, or the net value in the company. So we're basically looking at the net value. We're comparing how much of that net value is not owed, or is not an asset, is not owned by the owner, but is basically allocated to the third party, the third parties that we owe. So we've got the liabilities, third party that we owe, divided by the total equity, the net value, assets minus liabilities, the net value of the company. Next, we're going to hide some cells. I'm going to hide the rows, or the columns, I should say, from D to G, so that we can see the information that we're going to be working with right next to where we're going to be entering that information. To do that, we're going to put our cursor on D, so we have the drop down arrow, left click, and I'm going to select over to G, let go, then put our cursor on the highlighted or selected area, and then we're going to go down to hide, second from the last item, hide those columns, and there we have it. So there's going to be our information. Now we'll be working on the time interest earned. With the time interest earned, we're trying to figure out or compare how much the interest or the interest expense, or how many times over could we pay out basically the interest expense. Now the tricky thing about this is, one, whenever we do this type of calculation, we're going to basically be taking out the income taxes, because income taxes distorts things. And two, the net income is already having an interest expense in it. So we're going to have to remove the interest expense from net income. So those are going to be the two kind of tricky components to this one. So we're going to say, all right, we're going to start off with income before taxes. And again, we're doing it before taxes. So this is like net income before taxes, because we don't want to basically taxes kind of mess things up. So we're going to say, here's our income before taxes. And then we're going to be comparing or adding to that the interest expense. Why? Because interest expense was taken out of the income before taxes. We need to add it back in, because that's the thing that we want to compare here. So we're going to say, okay, here's the income, and we're going to add that back in. Here's going to be that basically the net income, not counting taxes and not counting the interest expense. So we're going to say this is going to be our subtotal, which we could call that, right? Here's our net income, not including taxes or interest expense as our subtotal, but I'll just call it subtotal. And then we're going to say, okay, now we're going to compare that to the interest expense, because what we're trying to figure out here is how many times over could we pay the interest. So you can imagine if we're a bank or something like that, that's what we're mainly concerned with. How many times over can they pay the minimum that is due to us, the interest on the loan? So now we're going to take the interest expense, and obviously to do that, we need to add back the interest expense, because we already have it deducted one time. We're trying to calculate how many times it could be basically paid over. So that's our calculation. Then we're going to have the time interest earned, the calculation being equal to the 56,850 divided by the 4,500. And so this is going to be the 12.6. In other words, we can pay over the interest that is owed 12.6 times with basically the net income that we have. This is another calculation where I think it's helpful to put it out in a vertical calculation type this and like this, and take each step at one time. Because if you see just the formula, then oftentimes they're going to basically, it's going to confuse you, because again, there's going to be multiple steps possibly in one line item or one item in a formula. So what you want to do is say, break this out in your mind, how you actually going to put this into a calculator. Best way to do that is to break it out step by step. And Excel is nice to do that, so you can kind of line the formulas up. Now we're going to take a look at the profit margin ratio. So the profit margin ratio is going to start with the net income. The net income is going to be equal to the 31,261 for us. And then we're going to compare that to the net sales. Now remember, the net sales is not net income. It's just going to be our sales line. If there was anything up top like discounts or allowances, you would be net of those, because those are basically, reducing the sales line. They're not expenses, in other words. So we're going to say this equals the 453,600, and then we can divide that out. So we'll divide that out now. So we're going to say that this is equal to the 31,261 divided by the 453,600, and that's going to give us the 6.9. And that should be a pretty common ratio that we've probably seen multiple times. It's going to be a very common ratio we have. We're going to be saying, okay, here's our net income. we want to compare our net income compared to the sales line. And that'll give us kind of an idea of of every sales dollars that we have, how much of that do we get to basically keep. So that's going to be a common type of ratio that we will see. And then we're going to take a look at the total asset turnover ratio. So total asset turnover ratio, this is another one that could be a little bit confusing because once again, we're comparing the balance sheet accounts and the income statement accounts. We're comparing balance sheet accounts, income statement accounts. When we look at the balance sheet account, we're going to be using this average type idea again. And whenever we see averages on a balance sheet account, usually your default thought is, oh, what's that going to mean? That means I'm going to have to take the beginning balance plus the ending balance divided by 2. Why? Why would I do that? Because we're trying to figure out, what the average type balance would it be at any point in time throughout that time period, even though the balance sheet accounts are, of course, as of a point in time, not a time, period or time frame. So what we're going to do, we're going to say, let's take a look at the net sales. I'm going to put that in the outer column. This is going to be the income statement account. Once again, this is not net income, but net sales. So we're going to pick that up top, the 453,600. And then we're going to pick up the average total assets. Average total assets. So we're going to make a subcategory. Average total assets are going to be the beginning assets plus the ending assets divided by 2. So beginning assets, where are we going to get that from? Because the balance sheet is as of the end of the time period. Balance sheet is as of the end of the time period. The beginning assets then are going to be the ending assets at the end of last time period, which we may have if we have 2 sets of financial statements, or we're going to pick that up from the added information as we have here, total assets being the 249,400 from the prior year. So we're going to say, all right, here's the prior year's total assets at the end because that's their ending, which is like our beginning. And then we're going to say this is going to be the ending assets, which are on our balance sheet, the current balance sheet, which are equal to the 252,800. And if we add those up, we're going to have a subtotal. I'm going to give a subtotal here. Summing those up equals the sum of the 249,400, the 252,800, and that's going to give us the 502,200. Then we're simply going to divide that by 2 to give us our average. So we'll divide that by 2. Going to pull that to the outer column now. This is going to be equal to the 502,200 divided by the 2, giving us the 251,100. And that, of course, is the average total assets. So again, if you see this in a formula, they're just going to basically say, hey, it's going to be net sales divided by the average total assets. And then again, this whole calculation here, you're just going to have to do separately. It's not in the formula at all. So what you want to do is know that, and when you see this type of calculation, format it in some way, such as this, where you actually have within your routine that you're going to be calculating each line item that you're actually going to have to calculate in some type of systematic way. Otherwise, you're going to be drawing a little line here, a little formula here, and say, now I need to figure this out, and you're going to be doing that like down here, and it won't be organized, and it's going to waste time. So if you have the setup and say, when I see this, I'm just going to set it up like this. When I see average total assets, I can do it by hand or whatever. As long as I can visualize what I want to set up, then I'll set it up in that format. And that's going to give us the total asset turnover. And so that's going to be equal to the 453,600 divided by the 251,100. That's the 1.8. Next one, also note as we go through these that we've formatted the cells for us here. So you'll note which ones are going to be in a percent format and which one are basically in a decimal type format, and just get a feel for that and as we go through these ratios as well. So these cells are pre-formatted for us to see those differences, but get an idea of that as we go through these. So now we're going to go to the return on total assets. So now we're looking at the return on total assets. We're going to have a similar type of situation with the average total assets, because once again, we're going to be comparing the income statement account and a balance sheet account. So we're going to say, all right, here's going to be the net income. Note here that we're taking the net income this time as opposed to the net sales. We're taking the bottom line of the income statement as opposed to the top line of the income statement. So we'll pick that up in J24. We're going to put that in the outer column, say equals, and we're going to say that that's going to be the 31,261. And then the rest of this will look much the same. So now we're going to have the average total assets. I'm going to do that with a formula down here. We're going to say that this is going to be equal to the average total assets right there. Enter. Then we'll autofill that down. It'll pick up the relative cell references. So I'm autofilling it down until it gets to that divided by 2. And then we're going to put the numbers, and the numbers will be the same as well. So I'm just going to be over here in I-26 and say that this is equal to the 249,400 and enter, and then autofill that down. So we'll be on the fill handle, autofill that down. Then I'm going to add the underlines back in just for formatting purposes, and the 252,800 will be in the home tab, font, and underline. And then in the 2, I'm going to go to the home tab, font, underline. And then we'll pull this out to the outer column now. So now we're going to say the outer column is the average total assets, which is equal to the 502,200 divided by the 2, which is the 251,100. And then we can, of course, calculate the return on total assets, which will be equal to the 31,261 over the 251,100. And we're going to get a return on the total assets of the 12.4%. Next, we'll take a look at the return on common stockholders' equity. Common stockholders' equity, return on common stockholders' equity. Once again, we'll be comparing a balance sheet and income statement account, this time starting off once again with the net income. So we're going to say net income up top. We're going to pick up the net income. This is going to be the top or the bottom line of the income statement. Net income, not the sales, not the net sales, net income. And that's going to be the 31,261. Preferred dividends, we'd have to subtract those out. So we'd say less, let's put less for subtraction. Preferred dividends, we don't have any, so that's going to be 0. That's going to give us our subtotal then. We're going to subtract that out, which of course is the same number as the net income, the 31,261 minus the 0. And then we're going to take a look at the average equity. So we're going to do the same thing. Equity is going to be a balance sheet item. And so what we're going to do then, beginning equity plus ending equity divided by 2, just like we have with other balance sheet items. So the equity for us is going to be the common stock and the retained earnings. Those are the 2 equity accounts. We don't have the subcategories here, so we can go in and kind of be able to recognize the equity versus the liabilities and pick up those numbers. So, and then we're going to start off with the beginning equity. So the beginning equity is not on our current balance sheet. This is the ending equity because the balance sheet is as of an ending point in time. We're going to have to go to the prior year balance sheet to get their ending balance, which is our beginning balance for this current period. So we're going to say that the equity then is going to be in our information in the prior year, which is going to be the sum of the 2 numbers of the 81,000 and the 51,139. That's going to give us the 132,139. So then we have the ending equity. So the ending equity, which is going to be equal to the sum of, and then we're going to pick up the common stock and the retained earnings here. So the 81 and the 82,400. And that's going to be our ending equity, and that'll give us a subtotal. So we're going to say, all right, that's the subtotal equals the sum of those 2 items. And then we're going to just take that and divide it by 2. So we took the beginning, the ending, dividing by 2. That's going to be our common average type of thing that we'll do whenever we have these balance sheet accounts. Keep that in mind. It could be a little confusing until you get the idea of it. We're looking for kind of the average balance at any given time, any given point in time, because the balance sheet account are as of the point in time of the time period we're in, typically a year in this case. So the 295,539 divided by the 2 gives us the average equity of the 147,770. Then we're going to have the return, finally, the final number, return on common stockholders' equity, and that's going to be equal to the 31,261 divided by the 147,770 for a 21.2%. These are a few other calculations just from a logistics standpoint that you're going to want to be able to break out what's going to happen, because we have these averages here, and when you see this just in a formula, these averages won't be broken out, and this is how you're going to have to basically put it into a calculator. Be aware of that. Think about that. How are you going to format these in an efficient way? And working with Excel helps you to do that because it helps you to kind of group your tables. Even if you have to do this by hand, you can then think, okay, this is how I'm going to group the table. Then when I do it by hand, I don't have a little space over here and this over here, then this goes up to there kind of thing. I've visualized it, and we can put it together in a little bit more efficient way, save time.